And that's when the entire game changed. 2022. While the world was distracted by inflation and war, central banks made the most significant monetary decision since Nixon closed the gold window in 1971. They stopped buying dollars, and they started hoarding gold like their survival depended on it. 1,080 tons in 2022, 1,050 tons in 2023, 1,089 tons in 2024. 3 consecutive years above 1,000 tons of gold purchases by central banks. To understand how unprecedented this is, the annual average for the previous decade was 472 tons. Central banks just more than doubled their normal buying rate and haven't slowed down for 3 years straight. This isn't a trend. This is a structural shift in how the world's monetary authorities view the dollar-based system. And it's happening for one reason: they no longer trust it. While central banks were buying record amounts of gold, something else was happening quietly in the background. The dollar's share of global reserves fell to 58.2% in mid-2024, the lowest level since 1995. In the year 2000, the dollar represented over 70% of global reserves. In 2015, it was still 66%. Now it's barely holding 58%, and the trajectory is unmistakable. Central banks aren't just diversifying, they're actively rotating out of dollar-denominated assets and into physical gold at a pace that suggests they know something the public doesn't. And I'm going to show you exactly what they're preparing for. Let me give you the framework for understanding what's actually happening, because the mainstream narrative that this is just prudent diversification completely misses the point. This is preparation for a monetary reset. Central banks hold reserves for 3 reasons: liquidity, to intervene in currency markets and manage exchange rates; credibility, to back their own currency and inspire confidence; and insurance, to survive financial crises when all other assets fail. For 50 years, the dollar served all 3 functions perfectly. It was the most liquid asset on Earth. Holding dollars signaled your country was integrated into the global financial system and could be trusted. And in a crisis, everyone wanted dollars because the Federal Reserve could print infinite amounts to backstop the system. But between 2020 and 2024, all 3 of those assumptions broke. Liquidity became a weapon. In February 2022, the United States and European allies froze approximately $300 billion of Russia's foreign exchange reserves as punishment for invading Ukraine. Read that again. The West confiscated the central bank reserves of a G20 nation. Reserves that were supposed to be sacrosanct, untouchable, the financial equivalent of diplomatic immunity. That single action sent shockwaves through every central bank on Earth. If Russia's dollars could be frozen overnight, whose dollars are truly safe? China holds $690 billion in U.S. treasuries. India holds over $200 billion in dollar-denominated assets. Saudi Arabia, over $100 billion. Every single one of them watched Russia get cut off from its reserves and realized, this could happen to us. So they did the only rational thing. They started buying the one asset that cannot be frozen, sanctioned, or confiscated by a foreign government: physical gold in their own vaults. UBS published a report stating bluntly that the freezing of Russian reserves has likely had a lasting impact on central bank behavior. That's banker speak for everyone is terrified and repositioning accordingly. Credibility started cracking under the weight of U.S. fiscal irresponsibility. The U.S. national debt surpassed 120% of GDP. Annual deficits are running over $1.5 trillion even during economic expansions. The Congressional Budget Office projects unsustainable debt trajectories for decades. Central banks are not idiots. They can read balance sheets. And when they see the world's reserve currency issuer running deficits that would trigger sovereign debt crises in any other country, they start questioning whether holding trillions in dollar-denominated IOUs is actually safe. In 2024 alone, China reduced its holdings of U.S. Treasury bonds by $55 billion. Not because they don't need reserves, because they don't trust the trajectory of U.S. fiscal policy. When the largest foreign holder of U.S. debt is actively reducing exposure, that's not portfolio rebalancing. That's a vote of no confidence. And where did that money go? Into gold. China added 225 tons of gold to its reserves in 2023 alone, the largest annual increase in its history. They're not even hiding it anymore. They're publicly rotating from treasuries into bullion. Insurance lost its meaning when inflation revealed that dollars are not a store of value. Between 2020 and 2022, the U.S. printed more money than in the previous decade combined. Inflation hit 8% in the U.S., the highest in 40 years. In that environment, holding reserves in dollars meant watching your purchasing power evaporate in real time. Gold, on the other hand, went from $1,800 per ounce in early 2022 to over $4,300 by late 2025, a 138% gain. Central banks that held gold preserved and multiplied their wealth. Central banks that held only dollars watched their real reserves decline. This is why surveys of central banks now show that their primary motivation for holding gold is effectiveness during times of crisis and long-term store of value. Translation: we don't trust fiat currencies anymore, including the dollar. So, who's leading this rotation? Because this isn't every central bank equally. This is a coordinated move by specific players who are actively trying to build an alternative to the dollar system. China is the architect. Since resuming public reporting of gold purchases in late 2022, China has added over 350 tons to its official reserves. But here's what's critical. China's official gold reserves are only 4% to 6% of its total reserves. Compared to the global average of 20%, China has enormous room to keep buying without even appearing aggressive. And they're using that room. In 2024, China bought gold every single month. Not because they think it'll go up 10%, because they're building the foundation for a post-dollar monetary system. At the same time, China reduced its U.S. Treasury holdings from over $1 trillion a decade ago to $690 billion today, the lowest in 17 years. That's a $310 billion rotation, out of dollars and into other assets, with gold being the primary destination. China isn't preparing for the dollar to weaken. China is preparing for the dollar to be replaced, and they're making sure they have the gold reserves to back whatever comes next, whether that's a yuan-denominated trade system, a BRICS currency, or a hybrid digital physical monetary regime. Russia was the pioneer. After being hit with sanctions in 2014 following the annexation of Crimea, Russia immediately began what can only be described as financial war preparation. Between 2007 and 2021, Russia increased its gold reserves from 400 tons to over 2,300 tons, an increase of 1,900 tons in 14 years. Simultaneously, Russia sold almost all of its U.S. dollar reserves, reducing its dollar holdings from over 40% of reserves in 2013 to just 16% by 2021. They replaced dollars with gold, yuan, and euros, anything but the currency that could be used as a weapon against them. And when the 2022 sanctions hit, Russia's strategy was vindicated. The West froze Russia's foreign currency reserves held in Western banks, but they couldn't touch the gold sitting in the central bank of Russia's vaults in Moscow. That gold became Russia's financial lifeline, allowing them to stabilize the ruble, back trade agreements with allies, and survive the most comprehensive sanctions regime in modern history. Russia's lesson to the world was clear. If you want true monetary sovereignty, you need physical gold in your own territory. Paper claims on foreign assets are just IOUs that can be canceled. India is the pragmatist. India added approximately 100 tons of gold between 2020 and 2023, bringing its total to around 800 tons. India's central bank has been explicit about why diversification away from excessive dollar dependence and protection against geopolitical and economic shocks. In 2022 alone, India bought 33 tons. In 2023, another 30 tons. And India simultaneously reduced its holdings of U.S. treasuries. selling about $5 billion worth as part of active reserve management. India isn't trying to destroy the dollar. India is hedging against a world where the dollar is no longer the only option. They're participating in BRICS discussions about alternative payment systems. They're settling some trade in rupees. And they're making sure that if the monetary system fractures along geopolitical lines, they have enough gold to operate independently. Turkey became one of the most aggressive buyers, adding 241 tons between 2022 and 2025. Turkey was dealing with hyperinflation exceeding 70% annually and a collapsing currency. In that environment, the central bank bought gold not as an investment, but as a survival mechanism. Gold was the only asset that held value while the lira imploded. Turkey's strategy was chaotic. They even had to sell some gold in 2023 to meet liquidity needs, but the overall trajectory is clear. Accumulate hard assets, reduce reliance on foreign currencies, especially the dollar. Poland shocked everyone by nearly tripling its gold reserves in just 3 years, adding 284 tons. Poland went from a modest holder to one of the top buyers in the world. The head of Poland's central bank stated publicly that he wants gold to represent 20% of Poland's reserves, up from 12%, because it provides confidence and resilience. Poland even repatriated all of its gold from London in 2019, bringing it home to Warsaw. That's not a financial decision. That's a geopolitical statement. It says we don't trust that our gold will be accessible if we need it during a crisis, so we're taking physical possession. What all of these countries share is a common realization. The dollar-based system is no longer neutral. It has been weaponized. And if you want to protect your nation's wealth and sovereignty in a fragmenting world, you need assets that cannot be sanctioned, frozen, or inflated away. You need gold. Now here's where this gets truly significant, because the central bank buying spree isn't just affecting gold prices. It's fundamentally changing the architecture of the global monetary system in real time. The price of gold has risen over 150% since 2022, hitting all-time highs above $4,300 per ounce in 2025. The World Bank directly attributes this to ongoing central bank purchases and safe haven demand. Central banks now account for approximately 25% of total global gold demand, up from just 12% in the 2015 to 2019 period. That means 1 out of every 4 ounces of gold demanded globally is going into the vaults of monetary authorities, not jewelers, not investors, not industrial users. Central banks have become the dominant force in the gold market, and their buying is price insensitive. They're not buying because gold is cheap. They're buying because they need it regardless of price. This creates a structural floor under gold prices that didn't exist before. Even if private investment demand weakens, central bank demand continues. It's a bid that never goes away. But here's the more profound implication. Gold is starting to function as a shadow reserve currency. When central banks accumulate this much gold while simultaneously reducing dollar holdings, they're effectively treating gold as an alternative to the dollar for the reserve function. The Bank for International Settlements, the central bank for central banks, issued a warning in late 2025 about this. They noted that gold is behaving differently than its historical pattern, trading more like a speculative asset, and that for the first time in 50 years, gold and equities are rallying together. The BIS is concerned that central banks themselves could be exposed if gold corrects sharply given how much they've bought. But here's what the BIS isn't saying publicly. Central banks are buying gold because they're preparing for a monetary reset. Not tomorrow, not next year. But within the next decade, the probability of a fundamental restructuring of the international monetary system has increased dramatically, and gold will be central to whatever comes next. There are several versions of what the reset could look like, and different analysts emphasize different scenarios. Bretton Woods III, Zoltan Pozsar, former Credit Suisse strategist, argued that we're witnessing the birth of Bretton Woods III, a new order centered on commodity-backed currencies. In this framework, the dollar-dominated system that emerged from World War II and evolved after 1971 is being replaced by a multipolar system where currencies are backed by real assets: gold, oil, other commodities. In this scenario, Eastern nations and emerging markets increasingly settle trade in currencies linked to tangible value rather than fiat promises. Gold becomes the reference point for value, even if currencies aren't formally convertible to gold. It's a soft gold standard, not rigid convertibility, but gold as the psychological and practical anchor. Massive revaluation of gold. Some analysts believe that to reset the global financial system and deal with unsustainable debt levels, there will need to be a coordinated revaluation of gold to a much higher price. $10,000 per ounce or more. This would instantly improve the balance sheets of central banks, effectively writing down debt burdens in real terms and allowing a fresh start. This is speculative, but the logic is straightforward. If fiat currencies have been debased through money printing and gold represents real value, then the current price of gold drastically undervalues it relative to the expanded money supply. A reset would correct that imbalance. BRICS currency backed by gold. Russia has explicitly proposed linking a BRICS common currency to gold. While no formal BRICS currency has been launched yet, pilot programs for gold-backed settlement units within the BRICS bloc were reportedly tested in late 2025. The idea is to create a trade settlement mechanism that doesn't rely on dollars, backed by the collective gold reserves of BRICS nations. China has over 2,200 tons officially, Russia over 2,300 tons, India 800 tons. If these and other BRICS Plus members pooled resources, they could theoretically back a significant portion of intra-BRICS trade with gold reference units, bypassing the dollar entirely. This wouldn't replace the dollar overnight, but it would create a parallel system, a bifurcation of the global monetary order into a Western dollar sphere and an Eastern commodity-backed sphere. Hybrid digital physical system. Another possibility is that central bank digital currencies are backed partially by gold to give them credibility. Imagine a digital yuan or digital ruble where every unit is backed by a fractional claim on physical gold held by the central bank. This combines the efficiency of digital money with the trust that comes from tangible backing. Gold becomes the anchor of the digital currency system, providing the psychological assurance that the money has real value, while the digital infrastructure provides the speed and traceability that modern economies require. All of these scenarios share a common thread. Gold returns to the center of the monetary system after 50 years of exile, and central banks are positioning for that return right now by accumulating as much physical metal as possible before the transition occurs. What does this mean for the dollar? The implications are severe, even if the process is gradual. The dollar's share of global reserves has fallen from 66% in 2015 to 58% in 2024. If that pace continues, the dollar could be below 50% within a decade. At that point, it's no longer the dominant reserve currency. It's just the largest among equals. Lower demand for dollar reserves means lower demand for U.S. Treasury bonds, which means higher borrowing costs for the United States government. Some studies estimate that every 1 percentage point decline in the dollar's reserve share could raise U.S. interest rates by 20 basis points over time. If the dollar's share falls another 8 points, that's 160 basis points of additional interest cost on a $36 trillion debt. The fiscal consequences would be catastrophic. The U.S. also loses its exorbitant privilege, the ability to run large deficits and borrow cheaply because the whole world needs dollars. As that privilege erodes, the U.S. will face the same constraints as every other nation, fiscal discipline or currency crisis. For the rest of the world, de-dollarization means more complexity but more autonomy. Countries can settle trade in local currencies, reducing exposure to Federal Reserve policy decisions. But it also means less liquidity, higher transaction costs, and more currency volatility. The International Monetary Fund has acknowledged this shift but emphasizes that it's gradual, and the dollar still dominates in most financial functions. The IMF projects that even with erosion, the dollar will remain the primary reserve currency for the foreseeable future simply because there's no full replacement. But foreseeable future is doing a lot of work in that sentence. 10 years ago, the idea that central banks would abandon dollars for gold at this scale was unthinkable. Now it's documented fact. The The question isn't whether the dollar will lose its dominance. The question is how fast and what comes next. And that's why central banks are hoarding gold. They're not speculating on a 20% price increase. They're buying insurance against the collapse of the monetary order they've known for 80 years. Look, I'm not a financial advisor. I don't know your personal situation. I'm not telling you to buy gold or sell dollars. I'm showing you what the most powerful financial institutions on the planet are doing with their reserves. And what they're doing is rotating out of paper claims and into physical metal at a pace that suggests urgency. Central banks have access to information we don't. They have economists, intelligence agencies, and geopolitical analysts feeding them data about risks the public won't hear about for years. And those institutions have collectively decided that holding dollars is riskier than it's ever been, and holding gold is more essential than it's been since 1971. When Russia's $300 billion in reserves got frozen, it wasn't just a sanction, it was a signal. It told every non-Western central bank, your dollar reserves are not actually yours. They're held hostage to U.S. foreign policy. And if Washington decides you're an adversary, those reserves disappear. Gold in your own vault cannot be frozen. It cannot be sanctioned. It cannot be inflated away by a foreign central bank's money printing. It is sovereign wealth in the truest sense. That's why 1,080 tons were purchased in 2022. That's why another 1,050 tons in 2023. That's why 1,089 tons in 2024. And that's why this trend will continue until either the dollar system is reformed to restore trust, or it's replaced by something else entirely. We're not in the speculation phase of this trend. We're in the preparation phase. Central banks are building the reserves they'll need for whatever monetary system emerges from the current disorder. And the centerpiece of that system will be gold. The reset isn't coming. The reset is already happening. It's just happening slowly enough that most people haven't noticed, but the central banks have noticed, and they're acting accordingly. The only question left is whether the rest of us will figure it out before the transition is complete and the opportunity to position accordingly has passed.